Oh my God, Meta Platforms just reported their Q1 print, and instead of me coming in here being really excited about shares of Meta, which are up nearly 4.5% in the after hours, I'm actually more excited about the semiconductor companies because Meta just gave us a figure that should knock your socks off of your feet. And instead of burying it later in the video, I'll give it to you right here at the top. So at the end of last year, Meta gave us their full year 2025 CapEx guidance for 2025. Their previous range was for $60 to $65 billion. Today, they just came out and upped that range to 64 up to $72 billion for the full year of 2025 CapEx. They did say this updated outlook reflects additional data center investments to support AI intelligence efforts, as well as an increase in the expected cost of infrastructure. Guys, if this is not sending bells and alarms off in your head, I don't know what will. This is ultra mega bullish for companies like NVIDIA and Broadcom and AMD and ASML and TSM, and you go down the semiconductor chain, it's just mega bullish. Because look, if Meta is out here upping their CapEx guidance for the full year, well, you better believe that you have companies like Amazon, Microsoft, Google, well, they'll all likely come in here and spend more than what they had initially planned for the full year 2025 CapEx, especially for data center investments. And again, this company is telling you right here to your face that they'll be spending more on CapEx for the full year. And that's coming at a time where they're actually lowering their full year total expense range for the full year. So despite lowering their total expenses for the full year, they're actually going to be increasing their CapEx spend on data centers and on AI. So if you want to click off this video, log into your Robinhood or whatever brokerage you use and go and buy shares of NVIDIA and Broadcom, well, now is your chance to do so. And I certainly wouldn't blame anyone in doing so. Now, in terms of Meta's results, I mean, we'll get into those. They look absolutely spectacular. This company is continuing to grow at a very rapid clip. They also provided revenue guidance for the upcoming quarter that came in absolutely spectacular. You also are getting very strong revenue growth from an advertising perspective. You are still losing a ton of money on the Reality Labs, and we have to get into that. But when we get to the technicals as well, you see this one is coming back up to levels we had seen previously in April, and it's looking to maybe reverse this downtrend that it saw at the start of this year. Hey guys, hope you're doing well out there. It's time to take a look at shares of Meta Platforms, which are moving nearly 5% in the after hours and being up nearly 26% over the past 1 year. It looks pretty good, but you have seen shares under pressure year to date, down about 6%. Keep in mind, at the start of this year, shares of Meta were actually on a really good winning streak. I believe at one point they were up for like 20 or 21 consecutive days. And so certainly having reversed those, and you're once again trading in the mid $500 range. At a point you were trading in the mid $700 range. And again, we'll talk about the growth rates over at Meta, which continue to stay extremely exciting. In fact, revenue growth came in at 16%, up to $42.3 billion on that top line, beating estimates by nearly $1 billion. You also got a huge bottom line beat, as you tend to get over at Meta, of nearly $6.43, again beating estimates by a whopping $1.21. In terms of all the important metrics over at Meta, well, they all continue to move in the right direction. The family daily active people, basically counting the number of people that use at least one of their services on a daily basis, hit nearly 3.43 billion people on average for March. That was up nearly 6% year over year. I mean, it seems like Meta is only going to stop once they have basically everyone on the earth using one of their family of apps on a daily basis. You also saw growth on your ad impressions, up about 5%, and the average price per ad up about nearly 10% year over year as well. So again, some exciting things to see over at Meta. The growth continues to remain there. And speaking of growth, in terms of the guidance for the upcoming Q2, well, they're guiding for a revenue figure somewhere between $42.5 up to $45.5 billion of Q2 revenues. That falls basically in line with what analysts anticipated at $43.5 billion. In fact, the high end was for 45. So Meta's high end range of 45.5 coming in actually slightly ahead of what the most bullish analyst on Wall Street was expecting. And certainly if Meta can come closer to this 45 range, well, then your growth rates are still, again, looking at 15% on a year over year basis. Again, telling you that this company is still growing in the low to mid teens for a revenue base north of $40 billion. And especially as you look out into Q4, where advertising and holiday spend tends to be a little bit more, well, then there you're looking at a nearly $50 billion quarter. And again, you look out to Q4 of next year, you're anticipating nearly a $60 billion quarter. So the way this company is growing revenues off of a base that's nearly $40-50 billion. I mean, that should tell you that the stock still, in my opinion, is a growth company, and that one that's not actually trading like an overly expensive growth company at just 22 times a forward earnings multiple. And considering the fact that they tend to come in with huge beats, well, that forward earnings multiple likely should be moved down a lot lower. Now, in terms of their different segments, of course, we know the advertising continues to power this business forward. That came in at nearly $42 billion in the quarter. That was up from nearly 35.6 same time last year. The advertising business continues to remain healthy and strong and continues to at least power this business and other parts of this business forward as well, because you see the Reality Labs segment. Last year, you earned $440 million. Well, this year, that actually declined down to $412 million. I mean, $400 million to start off with is absolutely nothing over at Meta, considering the fact that their family of apps is printing nearly $40 billion on a quarterly basis. So look, they can drop this on the sidewalk and nobody will notice over at Menlo Park. But what you will notice is the fact that the Reality Lab segment is burning nearly $4.2 billion of cash in a quarter. That's right, this is not for the full year. This is for the 3 months ended March 31. The Reality Lab segment now burning $4 billion every 3 months. I mean, that's faster than $1 billion a month. Compared to last year, that loss actually accelerated, as last year you were burning nearly $3.8 billion every 3 months. So, I mean, someone over at Reality Labs, again, like I've said, needs a reality check, because this company is just continuing to incinerate cash on this business. Now, that's fine as long as the family of apps continues to produce nearly $20 billion of operating income every quarter. But I mean, when you start to stack up the losses on the Reality Live segment, I mean, it just starts to hurt, because these $4 billion can be used towards a buyback, can be used to up the dividend, can be used to invest more in CapEx for data centers, can be used in a number of ways. But you have Mark Zuckerberg out there trying to build the metaverse, or at least trying to build the augmented reality and mixed reality headsets, which we know there's a relatively small market for. But again, as long as the family of apps and the advertising business continues to print money, well, then investors will certainly look the other way on this $4 billion cash burn, at least for the time being. Now, some of that $4 billion, look, some of that is of course for augmented and mixed reality headsets, but certainly some of that Reality Labs burn is for their AI push, which is not necessarily a bad thing, especially because they have to compete against the likes of ChatGPT, Gemini, along with DeepSeek. You can throw in Grok in there as well. So certainly Meta wants to be competitive in the AI space, in the chatbot space, in the LLM space, and they have to invest for that. And maybe some of that Reality Labs segment burn is due to the fact this company is spending quite a bit on AI as well. And today they in fact released a standalone AI app to compete with the other LLMs and other chatbots. We'll see how Meta is able to monetize this. Certainly, they have a slightly different business model, at least compared to the other companies you see here, not just because they're more open source and you have ChatGPT and DeepSeek, which are closed source. In my opinion, Meta is in a slightly different position than I'd say what OpenAI is in, at least, because look, OpenAI developed ChatGPT. They have the standalone app. What they want to get is the user base. Meta, in a slightly different position, has the user base through their family of apps from Facebook, Instagram, WhatsApp, and Messenger. They're instead trying to release a product to now monetize that user base from an AI perspective. And so they launched this Meta AI app. We'll see how they're able to monetize it over time. It's certainly built on the large language model Llama 4, which in my opinion is pretty competitive to the other LLMs out there. And be interesting to see as the competition in the space continues to heat up, maybe the costs for these companies begin to come down, at least from an infrastructure perspective, but also how they're able to monetize it. Maybe this service becomes a commodity and monetizing it actually becomes quite difficult, because we know all these companies from their LLMs lose a fortune simply because it costs so much on the infrastructure side, and it's very difficult to monetize it, at least at the current time. But look, Meta, I think, is actually in a unique position to monetize it, considering they have that huge user base already on their family of apps. And in fact, today, on their LlamaCon event, they released the Llama API, which again, if they're able to monetize it, that can help developers with a set of tools and capabilities for building and scaling Gen AI applications. If they're able to down the road flip the switch on monetizing Meta AI, well, then that can add probably another $100-200 billion to this company's value. If not, at least what that'll do is keep the market competitive for the other competitors, simply because they can't go up on price all too much, because you have free alternatives out there in the market. Now, in terms of the financials, I mean, things look good over at Meta, especially when you begin to turn a blind eye on the Reality Lab segment. Total revenues, $42.5 billion, up from $36.5 same time last year. Your cost of revenues did tick up from 6.6 up to 7.5. Again, some of that is due to the fact that infrastructure costs and AI costs continue to increase. You had a huge uptick on your R&D, up from nearly $10 billion to 12.1. Again, a lot of that probably going into the Reality Lab segment from an R&D perspective, but doing a relatively nice job controlling your sales and marketing, up from 2.6, call it, to 2.7, so hardly budging on that side. And then your G&A costs actually going down significantly from 3.5 down to nearly $2.2 billion on a quarterly basis. So the G&A costs over at Meta really held in check this quarter. That allowed your operating incomes to go from 13.8, call it, up to $17.5 billion in the most recent quarter. They're also now earning a fair amount of interest income on the cash on their balance sheet. So the company is looking good, at least from an income statement perspective, looking even better, I'd say, from a balance sheet perspective. We have a quarter-over-quarter view here, so not really a full year view, but you have nearly $30 billion in cash, another 42 in marketable securities. So you're looking at nearly $70 billion of cash and marketable securities over at Meta. I mean, this company is beginning to look like a Google in terms of their balance sheet. I mean, nearly $90 billion from current assets. And then in terms of current liabilities, that's sitting at just $33 billion. And then long-term debt of about $28.8 billion. Again, that is matched by the cash this company has on their balance sheet. So nothing to be overly concerned with at that point. Now, from a cash flow perspective, you got operating cash flows of $24 billion in the most recent 3 months. Now, like we said, this company is spending a ton on CapEx, and that shows up right here on the purchase of property and equipment, nearly $13 billion in this quarter. So look, if you were to annualize $13 billion, well, that'll get you to a figure close to $52 billion. And we just know this company told us they'll likely come in nearly $70 billion. So what you should likely expect is Meta in the back half of this year to significantly accelerate the spend on CapEx. I mean, I really wouldn't be surprised if we were looking at a Q4 CapEx figure north of $20 billion. And again, what I want to point out is this company just earned $24 billion of operating cash flows in a quarter. They'll likely probably spend $20 billion on CapEx just in the fourth quarter alone. So tells you the kind of scale and the velocity this company is accelerating those dollars on the data center. And again, that should tell you where those dollars will land on the semiconductor chain. Top of mind is, of course, NVIDIA and TSM and Broadcom, but you can likely go down the line and you'll see tons and tons of beneficiaries there. So you strip out this CapEx and you're looking at about 12, call it $10 billion of free cash flow in this quarter. And well, they used all of that towards their buyback. They also now pay off a little bit of a dividend. So this company did burn through a little bit of cash in the most recent quarter, but again, the stock was under pressure most of this quarter. And so them using more of that cash towards the buyback wouldn't actually say that's a bad thing altogether, especially considering the fact that now in the after hours, you're seeing the stock move up about 5.5%. Now, from a technical perspective, I mean, this one was locked in an uptrend since really 2023. You made your V-shaped recovery back here in 2022, and then you sort of were staircasing higher, sometimes broke to the top end of the range. You did break underneath to the bottom end of the range. Now you're once again looking to come back up here, and I'd say retest the bottom end of this channel. I think that would be your first level of resistance. Believe it or not, you probably have some stops along the way, considering you have some resistance right here at the $600 range, but I'd say closer to the $660, you'll likely see a rejection here. And this company, in fact, instead of getting all the way back up here into this uptrend, what I actually expect is for this one to begin a new set of uptrend down here in this sort of channel. Your downside from here is probably back here down to the low 500s, but then your upside is probably here closer to 660, if not higher, at nearly $700 a share. I mean, at the current time, certainly wouldn't blame anyone for stepping in and maybe nibbling into shares of Meta, considering the fact that we know the valuation is cheap. We know the revenue guidance for the upcoming quarter looks good. I mean, we heard from Visa yesterday that the consumer looks strong, and that likely means businesses will continue to still spend on advertising as long as the consumer is out there willing to buy some of those products. And in my opinion, Meta likely wouldn't have upped their CapEx guidance if they didn't think the back half of the year would look strong from an advertising perspective. So the fact that they actually raised CapEx guidance for the full year is actually a bullish sign that this company also sees advertising remaining strong for the rest of the year. That was my take on shares of Meta Platforms, a company I think should absolutely be in your portfolio simply because of how dominant it is, how many users it has, how it continues to monetize their different verticals. The valuation looks relatively cheap, and this company is now spitting off huge amounts of operating cash flows in the form of buybacks and dividends. I mean, there's a lot to like here, and based off of their CapEx guidance, my guess is there's a lot to like over at NVIDIA and Broadcom as well. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening. I'll catch you guys in the next video.